Welcome to the Leap Health Workplace podcast. Here we explore innovative, proven health and wellbeing solutions to drive your performance and productivity. Leap Health empowers individuals and organisations to prioritise their health and wellbeing as a catalyst to performance and productivity. We do this by providing workplace health and wellbeing performance workshops and also the Leap 360 one-to-one leadership coaching to drive health, wellbeing and performance, powered by the Game Changer Index Energy for Impact profiling tool. And we offer bespoke corporate programs to ignite proactivity in ownership at all levels of health and wellbeing as a catalyst to performance and productivity. Whether you're sat at your desk right now or on the move, get ready to listen, get ready to invest your time and take action straight after. I'm Anna Reddy. Let's get ready to make small steps to leap health. Welcome to the podcast today, and today I'm hugely delighted to welcome Ross Williamson. Ross is a chartered financial planner at PM+M Financial Planning, and he's going to tell you a little bit more about himself just shortly. We met not so long ago, small world, and realised that we were born probably around the corner from each other. But what was a bit of a rude awakening was probably that Ross was born about 20 years after me. So it gave me a bit of a realisation of my age. But what he's going to bring today is going to be a wealth of knowledge, looking at it from all different generational perspectives. But what he's just said, which is really, really powerful, which has really been thought-provoking, is that your future self is actually a stranger. None of us know who our future self is going to be. But how can we actually make predictions with that stranger in the future as to how we can plan well for the future? So I'm going to hold that thought there and let Ross introduce himself. And tell listeners a little bit more about who you are, Ross.
Padium is a small place, like they say.
It is.
Yeah, so obviously my name's Ross Williamson. I work as a chartered financial planner at PM+M. At PM+M, we are a fully integrated finance house, so we cover everything from accounts, audit, payroll, tax planning, and financial planning. So I joined the industry about 7 years ago now. And quickly into my time in financial planning, I sort of knew I wanted to steer myself closer to the workplace world. So I cover a lot of things auto-enrollment. So a lot of my job involves setting up pension schemes for employers, but we also do a lot of work around wider benefits. So that involves things such as setting up death in service schemes, which I know you're very familiar with, and the additional bolt-ons which come with a death in service scheme now. But also we are getting more and more involved with private medical insurance, which has sort of come to the front with the problems that the NHS are experiencing at the minute. So yeah, I've been doing this job for 7 years now. I joined PM+M 2.5 years ago now, and I've been working in our newly established workplace save and protect team for around 6 months now. So I'm finding my feet with the benefit stuff now.
Thank you, Ross. Thank you. And what really intrigued me when we spoke is the way that you bring finances alive. And I think there's been lots of misconceptions for a long time that to be in the world of finance, it's all about just the maths and being good at maths. But actually, what you do beautifully is break it down into meaningful terms so that you can engage people. And importantly, as you do, is engage people early on so that they're making those wise decisions for whoever that stranger is going to be in the future. So I'm really excited for our conversation. So I'm going to just own up a confession right now. When I was younger, I did used to delete the emails about pensions. I'm really sorry. And I'm sure, I have this frustration in the wellbeing world as well. I know we're talking about financial wellbeing, but like your physical and mental health as well. And I know that people in the workplaces delete their emails about them as well because they think they're too busy and too important to deal with emails like that. Why do you think people think that they're too important to prioritise the pension right now?
First of all, shame on you for deleting them emails, Anna. That's terrible of you. Why do I think people delete the emails or chuck the annual statements in the peripheral shredding machine straight away? I think the first thing is probably lack of understanding. a lot of people probably get the pension statements and don't fully understand what it's saying or some of the jargon which is included on it. So if you can't understand it, what's the point in reading it? And we also touched on the stranger future self. So I attended a CII event not too long back, and there was a fantastic speaker who mentioned that if you think about your future self, your current self sees that person as a stranger. So it's very difficult to sort of align what your future needs might be. And it's hard to think about what you might need in the future. So people find it hard to sort of put themselves on the right track to get to a destination which is currently unknown, if that makes sense. So I think that's a big problem. People forget that the pension is actually a means to retire, but a lot of people are unable to sort of encapsulate or think about what retirement actually looks like for them, and therefore struggle in the current period to think about what they need to do to get to that unknown destination, if that makes sense. So I think that's a big problem, because if you don't know where you get into, you can't do anything in the present moment to get yourself to the right place. Um, on top of that, I probably think there's a lot of trust in pension providers. So I think a lot of people probably have the fear factor towards changing anything with the pensions or investments. So there's probably an element of trust with the pension provider to sort of put them on the right track and automatically get them to the right destination, which might not always be the right thing to do.
Thank you. Yeah. So what I'm hearing is that lack of understanding, and again, that might be that misconception in terms of needing to be good at numbers to understand it all. And then that trust as well is really important when you're thinking about finances. And yeah, going to that, you don't always know what you're going to need in the future, but I guess 99% of people, when they get to, ripe old age, are not going to regret saving for the future and putting themselves in a good place, which again, I relate to health. No one gets to, if they're in their 80s and says, I wish I hadn't prioritized my health. So there's a little bit of certainty there in that realm.
Interesting question back at you, and we'll probably touch on this quite a bit. Do you think there's more we can do in society to educate people from a young age to understand not only their financial sort of positions and understand what pensions, ISAs are, but also understand their well-being and sort of understand how that could affect them throughout their working life?
Absolutely, definitely. And what we do see from data as well is that, the younger people value well-being more. The data shows us that they don't just value, they expect it in the workplace as well. And I think this is probably correlating with what you're doing in the workplace, educating people, that it's more expected now. It's not something, we're not quite there just yet. I know some recent data said that 17% of young people didn't even know who their pension was with, but we're not quite there yet, but we're going in the right direction. Young people want to be empowered more for financial security when they're older, but also for, the health and the well-being for the longevity. So yeah.
I think you're right. Knowledge is power, isn't it? And if you've got more knowledge at a younger age towards your finances and potentially well-being, you're kitted out better to understand it and make changes later down the road, aren't you? And having that confidence could lead to better outcomes over the longer term.
Definitely, definitely. And even when you look at inequalities and we talk about health inequalities, truly believe that probably the bottom line to it is education.
Yeah.
So yeah, I'm still in your conversation now, Ross. I'm gonna
Put the limelight back on me.
Pick on your expertise now. So what do you think is the real risk of delaying your financial planning? And just to make it, I know you explain things in really good practical ways.
Mm-hmm.
What does it look like? What do the costs look like in terms of practical terms?
I love this question because you could ask many questions off the back of it. So what does risk mean to you?
Oh, I like that. It's making you think deep.
So there's loads of different risks when you think about it. You've got investment risk, which is how comfortable are you seeing the ups and downs with investment markets? If you've got low investment risk, you probably want a more slow and steady investment, which isn't up and down as much. If you've got the capacity and willing to take higher risk, you're willing to ride the roller coaster a bit more. But I also say to younger people is also not having enough money to be able to retire when you want to, a risk in itself as well.
So, when we think about people's willingness for risk, do
Yeah.
you think it's more down to their life experience, to their upbringing, or do you think it's more down to their natural personality and energy?
Again, I think it comes down to education. Whenever I run financial workshops, ideally, when it comes to your investment risk, you want younger people to take higher levels of risk because you've got the time horizon to sort of ride them ups and downs in the market. And then as you get closer to retirement, you may want to possibly reduce the level of risk that you're taking because you're getting closer to the point where you need to access your money. So ideally, you want younger people taking higher levels of risk and then older people taking lower levels of risk. But if your money's not working hard enough for you in the early ages, it can sort of flip it backwards. So you might have someone at 64 who realizes they've not put enough money into the pension that they then need to take a higher level of risk to sort of carry them over the line and to sustain their retirement. So yeah,
Yeah.
I think it's something mainly geared towards younger people taking that investment risk. And I always liken it to gears in a car. So if you think about your risk spectrum, one being low risk, five being high risk, if you take a low level of risk, it's like driving slow. You're going to get to your destination safely, but it's going to take you a long time to get there driving in first gear. But if you stick your car in fifth gear, you're going to get to your destination quicker, but driving fast is dangerous. So you've got to be willing to sort of take the risk to get to the destination quicker, if that makes sense.
Yes, yes. And that education empowers you to make that greater risk, I guess.
Well, it empowers you to make the decisions at an early age so that you can do the
Yes.
right things later down the line rather than panicking as you get close to retirement, if that makes sense.
Yeah. So what do you see though, going back to those like life experiences? So say you've got someone, I don't know, in the 20s who's
Hmm.
been brought up and always had money worries and things have been a bit of a scarcity versus the person who's had everything handed to them on a plate and got whatever they wanted. How's their engagement and adoption to taking risks different?
I don't think there's much difference, to be honest, in them kinds of people. No. Um, when I speak to people like that, I think people think I'm some super whiz, which I've got all my pension qualifications, don't get me wrong. But at the end of it as well, I'm just a normal person, born in Padiham, currently living in Darwin, in a normal house, sort of doing a relatively normal job. And I think if you can bring your personality to the front and sort of bring any barriers down and just have an open and honest conversation and give facts about what people's options are, that can generally bring the barriers down for people and then lead to better outcomes when it comes to making decisions. Does that sort of make sense?
Yes, definitely. And that's going back to that piece that you highlighted right at the beginning, which is around trust, isn't it? It's around breaking down those
Yeah.
barriers and empowering them with that knowledge. So yeah. So in terms again of like younger people, do you think they're still making the same kind of mistakes that maybe people made 20 years ago in terms of finance? So do you think they're getting smarter with the finances?
Yes and no would be my answer to that. So I think probably the first thing, which is a positive, which has sort of been initiated by the government, was the success of auto enrolment. So auto enrolment was kicked in 2012, and that meant that all employers had to automatically enroll people into a pension. The early age is currently 22, but I know that there are some discussions about potentially in the future bringing that down to 18, which in my view is only a positive thing because it'll mean more people saving at an earlier age and that'll get the snowball sort of building up from an earlier starting point. So I think auto enrollment's been a massive success in the pension world, just in terms of getting people to save, because the onus is on you as an individual to jump out of the pension now rather than jump in, which has seen a strong uptake in people saving for the retirement. Um, I think one of the problems again mainly is the education piece. And I think if we had a sample of around 20 people who are under the age of 18 and we asked them what they'd been doing in their evenings, I think probably 99% of them have probably been watching Love Island on a Thursday night rather than the Martin Lewis Money Show. Um, but again, the education is power. So I think if we can encourage people to sort of understand how pensions work and what their options are at an earlier age, that will generally lead to better outcomes 20, 30 years down the road for these people now.
Yeah. And I guess that auto enrollment has avoided that procrastination and things, hasn't it? Because they're already enrolled, so it's not up to them to have to start that.
Yeah.
You kind of touched on the world of social media and how that changes things and
Yep.
what people are exposed to. Do you think it's a benefit in terms of like getting your finances in order, in terms of planning ahead? Do you think it's good having that access to data, or is it a bit of a hindrance?
So in terms of, do I think we should do more with sort of media personalities pushing pensions and savings as a cool thing?
Yeah.
I think do you know what? I think that would be a massive positive thing if the government decided to do that. I can't think of one sort of promotion which has sort of had a recognizable figure pushing pensions as a cool thing. Um, yeah, I do think that'd have a massive impact on people because young people are easily sort of molded, aren't they? And if we
Yeah.
can use these people who are inspirational to these young people to sort of give a positive message in terms of save for your future self and give information so that people understand how pensions work or investments or insurance, whatever it might be. I can't think of how that would be a negative thing. It's just who would have to facilitate that? Would it be a government thing? I don't know.
Hey, it could have been a real opportunity for you there, Ross.
Listen, I'm not well connected in the celebrity world, but if you want to facilitate introductions, you're more than welcome to do so.
Brilliant. So, in terms of like just creating a bit of clarity around what exactly is a pension, just get to the basics. And what is it, and why should we start one early?
What is a pension? It's a great
Yes,
question. We
we
had this
haven't actually
discussion.
addressed that just yet, have we?
No, we had this discussion last week, didn't we? So what is a pension? I like to keep it nice and simple. I think a pension is a bucket. Think of it as a bucket. So as a saver, you are the tap, and your tap is filling the bucket up with water, and that water is your money building up in the bucket. When it comes to retiring, you put a hole in the bucket, and that's your money coming out. So it's about managing the flow of the water out for the rest of your life so that it doesn't drop to zero. Otherwise, you're going to have to go back to work because you've no income coming in. So it's as simple as that. In technical terms, a pension is a wrapper. So it's something in which you hold your investments or savings in. It's similar to an ISA, so it's nice and tax free. You don't pay any capital gains tax on the growth on your investments or any income tax on the sort of interest or savings which are made within it. When you reach retirement, you can take 25% of your pension value tax free, and then the rest of your pension will be subject to income tax when you withdraw it.
Thank you. Thank you. Really concise and straight to the point. Brilliant. And that income tax as well, obviously, would be low, wouldn't it, when you're not working? So then that's the benefit of taking it.
Yeah, very common misconception is that people come up to you at 55 and say, I've got to take my tax-free cash. That is a massive myth. So you don't have to take your 25% all at once. You don't have to eat your cake at once. You can sort of take a slice and leave the rest if that makes sense. So generally my message when it comes down to the 25% is if you need it, take it. But if you don't need it, leave it to allow the snowball to carry on building up. Because 25% of a bigger number 10 years from now could give you a higher nominal amount than if you take it out now and stick it in a savings account earning 1% interest potentially. So yeah, that's a very clear message which I give to people when they question about taking the tax-free entitlement, because I know it's a very I can't think of the word to describe it. It's a very synonymous thing with pensions, taking that 25%.
Yeah, yeah. But quite rightly, again, thinking into the future, saving it could be a benefit. Brilliant. Got a great top tip there from Ross already. So we've discussed what is a pension, but I guess like everything, there's different types of things within there. So can you just give us a flavour of the different types of pensions that we should know about?
Shall we do the three most common ones?
Go for it.
Yep. So your most common pension is your typical workplace pension. So as we discussed, when you join an employer, you're automatically enrolled into a scheme subject to you meeting certain criteria. You'll have money coming out your payslip every month. Your employer will have money going into the pension, and also the government will give you an extra slice of tax relief on the contributions you put in. So generally, these are more simple wrappers. Every employer generally has a different scheme with different terms. So it's important to check what your charges might be and what your money's invested into. Generally speaking, when you're automatically enrolled into a workplace pension, you're invested into something called a lifestyling arrangement. And what that means in plain English is, by default, people who are under the age of 50 will be invested in a higher risk investment fund. And the thought behind that is, as a younger saver, you've got time to get your money working harder. So like we said previously, you can ride the ups and downs. And as you draw closer to the age of 65, the level of risk on your pension will automatically start to taper off. So it gives you that safe landing as you get closer to retirement. Lower risk, lower returns, but you're at the point where you could potentially need to take your money out. So you don't want to take that higher level of risk. Whether that's the right thing for everyone, to be confirmed, but that's how it works in default terms. So the second type of pension is something called a self-invested personal pension, or a SIP, and that's more of a platform-based pension. So generally speaking, these pensions are a bit more expensive than your group pension. In some cases, it's not. But the features around a SIP are a bit more sophisticated than a workplace pension. So a SIP will typically have access to thousands of different investment funds. So you'll have the opportunity to select different investments, but also it'll include features such as a drawdown facility, which will allow you to ultimately take money out of your pension when you do decide to call it a day. And then your final pension, which is sort of at the other end of the spectrum, is something called a stakeholder pension. These were introduced some time ago by the government as a sort of low cost pension solution for savers. These are typically more simple wrappers, so they offer a limited range of funds, but the charges are capped at 1%. So initially, the charges on them schemes were pretty low. But what I've seen over the last couple of years, it feels like in the workplace pension arena, as more people have got involved in the market, it feels like it's been a bit of a race to the bottom. So as more people have entered the workplace world, the charges have dropped, which has meant it's a more competitive place for employees to sort of save the money in the longer term.
Super, even more reason to be investing in your pension. Thank you. So those three key areas, which again we can put in the show notes if anyone hasn't absorbed all that information as a quick reminder. But then something else I wanted to pull on, Ross, as well, which we discussed a little bit and you told me a little bit more about, which was really interesting, is that salary sacrifice. And people have probably heard this phrase, but can you tell us a little bit more about what it is and how people can benefit from this?
I'd love to. Our marketing team will be angry at me if I don't immediately rebrand it as salary exchange. So yeah, you're right. Salary sacrifice has a bit of a scary ring to it, shall we say, because sacrifice means you've got to give something up to get something, whereas exchange has a bit more of a positive feel about it. You're sort of swapping rather than giving up. So yeah, we've seen a bit of a change in the terminology around salary sacrifice to encourage more uptake in it. Salary sacrifice, in a nutshell, is an agreement between an employer and an employee for the employee to give up a proportion of the salary in exchange for a non-cash benefit, which in our case is an employer's pension contribution. Now, the key benefits of salary exchange are that as you reduce your headline salary, the employee will benefit from a national insurance saving, which typically will mean more money landing in their bank account each month. But on the employer's end, there's also a benefit through an employer's national insurance saving. And this has been probably more topical over the last 3 months because employers' national insurance has gone up from 13.8% to 15%. So we're finding that a lot of companies at the moment are trying to buy into these small, quick wins. And salary exchange is one of them mechanisms, which is sort of a win-win at both ends because the employee sees the take-home pay go up and the employer also benefits from a saving at their end. So when it comes to the employer saving, there are three options available. The employer can keep the saving to sort of offset the recent NI increases. They can recycle the saving back into the pension scheme, which leads to an increased contribution for the employee, an additional benefit. Or the third option is that they can retain the saving to finance additional benefits. So, like we mentioned before, potentially financing wellbeing workshops, financial workshops to sort of help people understand the pensions and options around it. Or also they can be used to finance additional benefits such as death in service schemes, private medical insurance schemes. So we've sort of seen a bit of a mix across the employer spectrum. Some are keeping the savings, which is sort of understandable given the context of the financial landscape. We're seeing some employers putting the money back in to reinvest into the workforce. And we've seen some employers pick up a combination of them both. So they've been keeping some of the saving and then using some of it to finance additional benefits, which is great to see.
So there's a huge opportunity there, isn't there, with so many wins at different levels. What have you seen the uptake like? I mean, obviously you're going into workplaces and they're seeing those benefits, but in general, what is the uptake of people really capitalising on this opportunity?
It's a great question. I think that's the benefits of taking advice when it comes to implementing salary sacrifice. So when it comes to implementing salary exchange, there are two main methods which it can be done. So the first one is through a change of employment contract and getting employees to sign agreements to move on to salary sacrifice, salary exchange. The benefits of that is it gives a clean audit trail. So you've got a clean audit trail showing who's agreed to move across and who hasn't. The downside with that option is similar to your auto enrollment. If you put a paper form in front of someone, the typical uptake isn't going to be as strong as if you do it on a basis where it's going to happen unless you say you don't want it to happen. So that leads on nicely to the second method, which is our preferred way of implementing salary exchange. And that's through something called negative affirmation. And what that means is we go into employers, normally typically joined by our fantastic financial wellbeing presenter, Neil Welsh, and we deliver a presentation explaining the benefits of the new pension scheme. And then we also integrate some financial wellbeing and retirement tips into that sort of workshop. And as part of that, we explain how salary exchange works and what the implications could be to individuals if they do move on to salary exchange. But through delivering them presentations, it allows us to communicate, this is what you need to consider, this is when it's going to happen. And if you don't opt out, it's automatically going to transition at the same time. And typically through doing it that method, we do see a lot more stronger uptake in people uptaking the salary exchange agreements. So we've done 3 schemes in the last couple of months. And on all 3 of them schemes, we've seen 100% uptake in the workforce of people moving on to salary exchange. I would note what we always do as well is we don't like to go in and do a presentation saying we're going to implement salary exchange. This is the benefits of it. Because normally you get questions on the back of that, such as, why weren't we doing this before? This seems like a no-brainer. So we like to pitch it as more of a XYZ Limited have asked us to look at the pension scheme as a whole. And as part of that process, we're going to implement salary exchange. And the benefits of doing it that way is it tends to lead to better outcomes for everyone through potentially better investment performance on the scheme, potentially lower charges attached to the pension, the newer pension scheme, and then everyone gets the benefit of salary exchange, the employer through their saving and the employee through an increase in take-home pay. So that's how we like to do it anyway, and we've seen great success in doing it that way with the employers we work with.
Well, certainly, if you've got 100% uptake, then you have got success with that. And I guess it's far more powerful, as you said, than just putting a piece of paper in front of someone and saying, sign up to this, when they might not even know what salary exchange means and get confused with it used to be sacrifice. And then I'm also a bit to follow on from that, thinking that because you're going in and educating people, and then they think, right, I'm going to prioritise my pension and sort out this salary exchange, then I guess that has a ripple effect, does it, in terms of their other financial choices, and relating it back to well-being again. Once you start to chip away at one thing, maybe you start thinking, I want to focus on my sleep, then you start to think, well, I'll do a bit more exercise, and then you'll think, I'll eat better.
Yep.
I'm guessing, do you see that kind of chain reaction?
Do you know what I describe it as? It's the eureka moment you see in some people, isn't it?
Yeah, yeah,
So you probably see it when you do your workshops. A lot of people who you speak to in the workforce have never had a conversation with an expert about well-being, pensions. So when they're sat in that presentation, things come to life which people didn't know existed, or you could do if that makes sense. And I think that's part of the reason why I love doing workplace so much. The fact that you can, when you set up a scheme, you're not just impacting one person. Through setting up that new scheme, you're potentially impacting 100, 200, 300 people at once, but also the benefits of speaking to people who probably need or value the advice more. I love the eureka moments. I love it when you sat there doing the presentation and you say something and someone goes, "Oh, I didn't know that," because that
yeah,
shows that A, they're listening to you, which is normally a good sign, and B, you're actually delivering something which is useful and empowering people to make better decisions later down the line.
yeah, yeah. And the earlier they can have those eureka moments, then the greater the return on investment throughout their life.
Knowledge is power. We'll say it again.
It is empowering yourself to know that stranger in the future. So we're going to bring it to a proper example now, Ross. I'm going to ask you around a specific example. So we're going to think about someone now, maybe about 30 years old, earning £40,000 a year. What might be a sensible monthly or yearly pension contribution to set them up for the future?
It depends. It depends on when you want to retire. So if you're 40 years old and you want to retire at age 50, you've got quite a lot of saving to do in such a short space of time. It depends on what you want your retirement to look like. So a lot of people think retirement is a lineal thing, which in reality, it's definitely not. So to some people, retirement might be going for a walk and going fishing, Whereas to other people, it might be going to Barbados twice a year and seeing the family twice a year and going on Turf Moor to watch Burnley every week. Unless you know what the stranger in the future wants or your future self wants, it's almost impossible to put someone on track to get to where they want to, if that makes sense. So it all depends on what you want and what you've got in the background already. So if 40-year-old has been well disciplined and saved up to that point, the answer might not be you don't really need to save much now and you can start to enjoy the next 10 years before you retire. Whereas if you haven't saved well previously, it might be the other end where you have to start putting money in and you have to really think about what you need in the future. So yeah, I'd say it depends. I think that's the realistic and honest answer. And I'd say that's where the value of financial planning sort of comes into fruition. So I think about 10 years ago, it used to be known as financial advice. So you go and speak to an advisor and they would advise you. But we've sort of, as an industry, transitioned away from advice to planning. And that's because the job isn't just about telling you what to do here and now. It's about putting you on the right road to get to the destination which you want to get to. And our job as financial planners is to put you on that path to get to where you want to go and to get you thinking about what you need in the future and when you might need that money. So yeah, it depends is the honest answer.
Thank you. Okay. First and foremost, before I just start to unpick this a little bit, I am very glad that you used the example of Turf Moor and not of Rovers. So thank you for doing that, Ross. Then, just to ask our listeners right now, just maybe start you thinking down this path. There's two things that Ross highlighted then. When do you actually want to retire? So that would be one key question. And then what do you actually want your retirement to look like? And those aren't just the two things you've got to think about. And as Ross said, he's empowering people to go down the right path. And it's not about people, that advice and dictating about what you should do. It's about co-creating. And when we know that when people co-create things and are part of that decision, you're far more likely to stick with it. And if it's far more individualized to you, it's going to be better. So, but yeah, just to maybe start you thinking a little bit more about where you might be wanting to go, when do you want to retire and what do you actually want that to look like?
Do you know what really scares me when I go into employers? Well, it doesn't scare me, but it surprises me. The number of people who come across to you and say, I can't retire or I won't be able to retire. And whenever I get that, I always put it back on the person and I always say, what makes you say that? And a common answer is state pensions going back. I'm never going to reach state pension age. But again, when you sit down and reverse engineer it and say, do you know when the earliest you can retire is? And you explain it's actually 10 years before your state pension kicks in, you can sort of pull the lever and jump out into retirement. People are surprised because they're not aware that you've got the flexibilities with your pensions and you've got the flexibility to retire whenever you want to. One of the key benefits which we draw on as financial planners is something called a cash flow model. So that illustrates what people's pensions could be worth in the future. And then through that co-creation element, sitting down speaking, what do you want your retirement to look like? Through the cash flow model, you can then sort of illustrate to the individual what will happen to their pension value if they do go down the current road. And that can be very powerful for people because it allows people to see what's going to happen if they don't do anything. But more importantly, it allows you to put people on the right track to make the right decision. So, for example, if someone's 50 and the cash flow model shows that they're going to retire at 65 and run out of money at 75, it allows you to have them open and honest conversations to say, look, based on what we're currently doing, you're going to be going back to work at 75 or beans on toast on a Saturday night, whichever you want it to be. But these are the steps we can take to sort of get you on the right track so that you're not having to go back to work or starve yourself at the weekend. And that can be really powerful in the planning process, illustrating where you're going and then coming up with them remedial steps to put you on the right direction.
Yeah. Sounds like it's just creating that clarity in your head, which then reduces lots of stress and anxiety about the future. But also, if you don't understand it in your head and what you're doing by showing that data is creating that clarity, um, then it becomes overwhelming. And that's when people do procrastinate on things, when it
Yeah,
becomes overwhelming. I'm going to add another question I want people to think about then. Do you want to be that person that says, I can't retire? Um, and although we've got a stranger in the future, I'm guessing that no one wants to be that person that thinks they
yeah.
can't retire.
I guess if you are that person thinking I can't retire, I would probably encourage you to speak to someone because, like we said, it gives you the facility to see if you actually can, or if not, the earlier you speak to someone, it allows you to put them steps in place to get you on the right track. So yeah, anyone who's thinking that, I would say, please, please, please speak to an investment professional or independent financial advisor.
Yeah. And we know in terms of bringing it back to the health again, like the NH has just published a 10-year plan, haven't they? People are living for longer. And you've got to think if you're living for longer, you still want to have a good quality of life. You don't want those years to be compromised. You want them to
No,
be quality years and not just looking at the quantity. So even more reason really to be getting, sorting out your financial well-being and really thinking ahead. Um,
it's a really interesting point that because I said retirement isn't linear and it's sort of different for everyone, but also throughout your retirement is not the same throughout. So yeah, that's a great point. What we see with a lot of people is people tend to spend a bit more in the early years whilst they're mobile and able to enjoy holidays away, time with family. But then later in life, there might be the need to reduce that expenditure due to your mobility decreasing. And again, through the model, we are able to sort of facilitate them variables in and have them open and honest conversations about what future needs might be.
yeah, so it really does go beyond just the maths. It's really thinking about the quality of your life as well. So I know we focus primarily on pensions, Ross, but you're still an expert in financial well-being, and there'll still be people sat here thinking, well, I've got money worries in all different areas. What
Yeah,
would be your top tips around financial well-being? What would be those key things that we're going to get good return investments if we get a hold of?
it's my top three financial well-being tips. You'll like number one. So number one, I would say if you are part of an auto enrolment scheme, so the likes of a Royal London Workplace Pension, a lot of providers actually have access to a financial wellbeing tool within them. So if you go on the Royal London Financial Wellbeing tool, I know it goes through a series of questions asking you about, do you have a mortgage? Do you worry about your mortgage payment? Have you got insurance? Do you worry about not having insurance? And at the end of the short survey, it sort of gives you a wellness score, I think, out of 100. 100 being don't change anything, your life is absolutely perfect. One is you're probably not sleeping at night and you've got a lot of financial problems. And the most important part of them tools is it gives you hints and tips on what areas you need to focus on and where you should look at directing your money. So a common example is we see a lot of people don't have a healthy emergency fund. So if something goes wrong at home, they don't have cash in the bank to fix the car, fix the boiler, all life's essential unplanned events. So it points you towards sort of things you might not think of, if that makes sense. And it also gives you small tips on how to address them points. So we all know if you've not got any money in the bank and you need an emergency fund of, let's say, 2 grand, it's not going to happen in a month, is it? So it gives you them small tips on how to build towards getting to them goals. And the benefit of these services, they're actually free to use. So it doesn't cost you a penny to go onto these services and use them. So if you've got a pension scheme and you're worrying about your finances, I would encourage you, please, please, please use these services. Um, Second financial well-being tip, I would say it's as simple as look at your money coming in every month look at your money going out every month for your essentials. So that's things like gas, water, electric, mortgage, insurance, and then look at what you've got left and factor in things you want to do, which are fun, because we're all human and we want to live for now. And part of your longer term well-being is being well now, because your future self will probably thank you if you're healthy today. Think about your holiday requirements, things which give you a general sense of satisfaction. And then after all of them deductions, with what's left, you need to think about what do I do with this money? And that answer might be if you don't have insurance, think about buying a life insurance policy because at a younger age, generally the cost of insurance is a lot cheaper than leaving it later down the road. So your future self will definitely thank you if you do buy insurance at the earlier years. And then with anything else which is left, you've got options of investing for the longer term. And that might be through pensions, through work, or if you're thinking slightly shorter, longer term, it might be through an ISA in the background. So it's as simple as that. Look at your money going in and out and look at what's left at the end. And then the money which is after the fun stuff is there for your longer term financial planning needs. And then the last thing, ooh, 3 practical tips for financial well-being today. I would put it on employers. So again, I'd flip it back around and say if you're an employer and you're not using your salary exchange, it's definitely worth looking at because it gives you a saving. And as an employer, can you provide additional benefits to your team through pension workshops? So through the delivery of what we do through health and well-being and financial workshops, or even get a member of the finance world to come in and deliver a presentation on how pensions work. So I know Neil Welsh, who's a fantastic financial planner in our team, goes across the Northwest delivering financial well-being sessions. And I know he gets absolutely fantastic feedback from the companies which he goes to for delivering these sessions. So yeah, I put the onus on employers. There are hints and tips or tricks you could make which could subsidize the cost of them benefits. And coming back to your world, investing in your people is surely a good investment for your business.
Thank you. Some really good 3 top tips there. Thank you. And I think I know Neil Welsh as well. And I think I've heard him speak before. He's very good. So I would champion him as well. But love that, looking into those resources from your auto enrollment, which are just going to create a bit of clarity and take away some of that uncertainty. And uncertainty is one of the biggest things to cause us stress and anxiety. Number 2 was just a bit of a realization. Look at what's coming in and what's going out. And it sounds dead simple, but so many people don't do it. And then 3, employers, you need to be a part of this. You can't just leave it up to your employee. You need to steer this journey as well. So thank you very much for that. I'm really conscious of your time, Ross. We are coming to a close. And I was going to ask you a little bit more about some of the misconceptions in terms of financial planning and numbers, but I think we've covered that really. So I'm going to ask you something different, which is off the plan. Tell me a real eureka moment for you when you felt like I've made a real difference to someone here. But maybe one of your sessions where you've been delivering financial well-being and salary exchange, and you've just really seen that you've made a difference to someone.
Wow, that's a great question. So a massive eureka moment for me. I met somebody previously, and when we first met, I always have an acid test when I speak with people, and I echo this whenever I go into the office. If I meet with someone, and I was taught this when I've joined the industry at a very early age, and I've kept it with me since. If I'm ever sat in front of somebody and I'm providing them with advice, if I can't sit there and say, if you were my mum and dad, this is what I think you should do, you shouldn't be doing it. So I always live and die by that rule. If I couldn't tell this to my mum and dad, I shouldn't be doing it. And I met up with someone previously, and they'd built up pension, they'd retired, and they weren't taking any money from it. And we had a really open and honest conversation. And I said, "You've worked all your life, you've built this money up. You've sort of got two options. You're well now and you're enjoying your retirement and you're going out for lunches and whatnot. You can either watch the number tick up for the rest of your life and do nothing with your savings, which you built up. You can start to take it and maybe instead of eating in 5 days a week, you can go out for lunch once a week." And it's moments like that, I think, which really resonate with me, knowing that someone had a preconception of what they could or couldn't do, but then you go and speak to them and tell them they can do this, and that leads to a better quality of life for them. So they're able to socialize more, maybe go on a holiday once a year, which they didn't think they could do before. So that was a eureka moment for me. I always remember my first workplace pension scheme as well. And this is less of a eureka moment, but I think it's a memory which will stay with me forever. I remember going over and delivering my first ever presentation to a workplace and sort of promoting the new scheme and the benefits of a lower charge and salary sacrifice. And that always stays with me, I think, just because it was my first. I absolutely love the workplace world. And it mainly comes down to like what I said before. I take massive, massive pleasure knowing that when I set up a scheme, I'm not just impacting one person, you're potentially positively changing the financial futures of 200, 300 people in a factory. And that's what gets me out of bed in the morning, knowing that I'm making a massive, massive difference through what I'm doing. And I couldn't be more lucky doing what I do. And PM+M have given me a massive privilege being able to set up this workplace team and sort of deliver what we're delivering now. And we're doing an absolutely amazing job at positively impacting people's finances. So thinking on the bigger picture, I'm massively proud of what we do. It's really hard to pick out a single eureka moment, Anna. Honestly, it's you see so many people.
Yeah.
It's amazing.
Thank you, Ross. And I think probably what you've done for our listeners is what I really heard before is just that true passion and love for what you're doing and how wide your reach is. And I guess it's not just that 200 or 300 people in the business, it's then how that impacts the people around them as well. And then again, going back to your point around, you'd say, would I do this for my mum or dad? When I worked in pharmaceuticals years ago, and you'd know that healthcare professionals were maybe just prescribing the cheapest thing available. That was often a question: would you prescribe this for your mum or dad? So, yeah, a great one to think about. So, final question. Well, two questions. In fact, I'm sneaking two quick questions. Right. What will be one bit of advice to your younger self that you wish you'd have known about finance? And then the second, very important question I want you to tell our listeners is, where can they find out more about you and how can they get in touch with you?
You're writing me off as old already.
Not as old as we, nowhere near.
It's funny how you mentioned that because I've been part of a fantastic group called Lancashire Junior Professionals, and I actually retired from that group 2 months ago now. I said to him, I'm getting married next month, so I don't know how long I can be classed as a junior for. Um, so one piece of advice to my early self. Do you know what? I never look back and regret what I do because I always think you've got learning from the past and you can use that to positively drive you forwards. Um, I don't regret anything, but I think one thing I would urge younger people to really think about now is university and the need to get a degree for your profession. I think it's a massive decision for younger people now to decide, do they need to go to uni? Should we do an apprenticeship? And that's because your loans become longer and potentially more expensive. I didn't know it actually, and this is probably my own sort of downfall. I always had a passion for maths when I was at school, so I sort of knew finance was the way I was going to go. And I went to University of Nottingham, studied finance and accounting, and I sort of knew that financial planning was probably the direction I wanted to go. just because I like the human element and the ability to get to know someone and then positively impact the finances through making decisions. So I really love that people element. So that's how I ended up in financial services. But at the time, I was completely unaware that you didn't actually need a degree to become a financial advisor. So there are routes into the industry which don't involve a degree, a student loan, student debt, 3 years out of your life, and you can actually jump into the profession. Most employers will fortunately pay for you to get your qualifications in the background. So yeah, I would say to people, if you are a younger individual, really think about what you want to do and really research the routes to get to your destination, similar to a financial plan, but we'll call it a educational career plan. Think about where you want to go and actually think about the ways to get there. And a degree is not always the answer. And if it's not, there's benefits of doing your apprenticeships. You get practical experience, you get paid a wage, and you've potentially got a relationship with an employer who might give you a job at the end of it if you do really well. So yeah, that'd be my tip to younger people. Probably myself as well, to be honest. Maybe I didn't need to go to university, but I don't regret doing it. No.
Super. We've got a financial plan advice there as well as career.
Life advice.
Super. Thank you. And yeah, just the final question is, where can people find out more about you and how can they get in touch with you?
Great question. People can find me on the PM+M website. So if you go on PM+M, you can see all our different departments. If you click into the financial planning section, you can get my phone number and email address, which is ross.williamson@pmm, it's a bit of a mouthful, .co.uk. But I'm also on LinkedIn if anyone has any pension/auto-enrollment/salary sacrifice/salary exchange related questions.
Super, thank you. And I will put those in the show notes as well if you haven't got a pen and paper to hand. And maybe it'll look, you may be out walking and get a bit of fresh air while you're doing it. So we'll let you off the hook for not writing it down. Everything will be in the show notes. That just leaves me to say a huge thank you, Ross. That has been massively valuable, really informative, and it's been a pleasure to have you on the podcast.
Thanks, Anna. Always good to catch up with you. Thank you.
Thank you. So before you stop listening, I want you to pause. What did you take away from the podcast today? What small steps will you start? And what did you hear that you know could help someone else to make small steps to lead their health, well-being, productivity and performance? Please do share this episode and please subscribe to the podcast. And remember that Leap Health are here to provide workplace health, well-being and performance workshops, one-to-one coaching and bespoke corporate solutions to help the world make small steps to leap health, well-being, productivity and performance. Please do get in touch. It's Anna at leaphealth.co.uk. Have a great day.